listening to Rate Ready Radio, brought to you by Mortgage Financial Group, NMLS number 219650.
Hey, welcome to the Rate Ready Radio podcast, the start of 2025. I can't believe we're in 2025 already. This has just been an incredible year for 24. Looking forward to seeing what 25 brings, because 24 is such an up and down year. So I'm here joined today by Rich Lemoyne, again, one of our top team guys here. Excited to have you, Rich. Thanks for coming.
Thank you for having me.
And just wanted to try to talk a little bit about what we think 2025 is going to look like. I think this is going to be an important year for mortgages, for real estate, and I think we need to kind of address a lot of the misnomers that are out there and try to help people understand what can be done to get them in houses today at something they can actually afford.
Absolutely. No, I think coming off of 2024, we made it through the election cycle, so that's over with. We're moving forward. Beginning of the year, optimism. That's what I keep on seeing. I keep on hearing a lot of positivity. A lot of people, the market may not be perfect, and we obviously want lower interest rates and everything, but the phones are starting to ring again. People there's excitement. People are making plans. So I think 2025 is starting to shape up to be, a year of growth and optimism in the market.
Yeah, we've talked a lot on this podcast about Fed funds rates and all that good stuff, and how Fed funds don't work with mortgage rates, and we're kind of showing it right now because mortgage rates right now are at a 6-month high. We are somewhere in the neighborhood of the upper 6s to low 7% range, depending what kind of program you're going with. And that's what we've been trying to explain about the Fed funds when they say we're going to lower a half a point. This last one was a quarter point. It doesn't lower mortgage rates necessarily. It's all the other economic data, and of course, inflation and jobs are the big two things. And so we're in a position right now where we're watching what rates are doing. There's a lot of anticipation what rates are going to do. There was hope at the middle of last year that maybe the end of this year we'd see 5% range. I think most economists now are somewhere in the 6.25 range, the 6 1/8 range, but not until the end of the year. So what does that do? What do you think that does for the selling cycle as far as buyers are concerned? And why should they go now?
Well, you should go now for a couple of reasons. One, you got to start looking long term, not just what's it going to do immediately. So what happens if these prices start to go up? If interest rates come down but prices go up, it's a wash. So if you can get into your dream house or a house that you really want or need to move to, now might be the time, with the idea of possibly refinancing in the future to drive down the rate once they get into the 5s, or maybe you can even buy it down into the 4s depending on where the market is when that comes. It's not going to be this year. It's a little bit more, forecasting of the future, but it sounds like it's going to be reasonable to start thinking that way.
Yeah, I totally agree with you on that. The equity position you'll gain now is worth the chance of rates. With some of the programs that we do, we push a lot of the government programs, FHA, USDA, and a few. And we're going to talk about USDA in a second. But FHA loans, they have a great program called the Streamline Refinance. And one of the things Mortgage Financial does is, of course, if you come back through us and we do a refinance for you after we've done your first loan, we don't charge you closing costs as far as the lender is concerned. And so that's one of the things that with the FHA Streamline Refinance, it allows you to lower your rate without any qualification, truly. There's no appraisal, there's no credit checks, there's really nothing to it. As long as you made your mortgage payment on time, we're happy. So if you're going to make your payment at 6.5, you're certainly going to make your payment at 5.5.
Right.
And so these programs are there to help buyers in the future lower those payments. But if you go now, you'll gain your equity position on top of it. And so, yeah, I agree with you on that. It's now's the time to buy, and I think our phones are starting to see it. We've been busier here in the last couple of weeks than we've been in a long time. And I think everybody finally got through the election cycle, and the fear is all done, and everything's gone. And so now they're going to say, okay, now let's start getting back into the game. And I think that's what we're starting to see.
Yeah, I mean, like we said, election cycle's done, Christmas is done, everybody's starting to move forward. So people are starting to think, hey, do we want to move? Can we get into the marketplace? Some people are actually even thinking about, wait a minute, let me look at my overall finances. Yes, I might have a 2 or a 3 or 4% interest rate, but if you refinance now, pull out some of that equity, your monthly personal budget may go down significantly depending on what kind of debt load you're handling right now. And yes, it shocks the system a little bit of, hey, I'm going from a 3% interest rate to a 6 something. But if you save a couple $100 or maybe even more in some cases that we've done refinances here on lately, it makes sense for those people.
We know based on last year, there's a lot of people that have been living on credit cards. Last numbers that I saw was the United States is approximately $1.78 trillion in credit debt.
That's a T.
Yeah, 1.78 trillion.
Yes.
Astronomical. I can't even fathom what that would look like if you put it in a bank.
Yeah.
Right?
Mm-hmm.
And so, yeah, if we can figure out, you can pay on that minimum payment and you'll pay it for 20 years and maybe you'll pay it off. And so if we can figure out a way to get you in a steady payment to where you can knock it all out in one shot, yeah, there are ways to get your payments, the overall payments down, even though the mortgage payment might come up. On top of it, still has a deduction. So.
Right. No, I think people are starting to look at that because, like you said, that's a big number of credit card debt. And so if during COVID, if you refinanced into that lower rate, but then you unfortunately through different events, possibly have racked up some credit card debt or bought a bunch of toys that are, kind of saddlebagging you a little bit right now, like it may be a chance for you to, lower your monthly expenses and, keep moving forward to doing what you want to do and be taken care of, relieve some of that burden that some families are feeling right now.
Yeah, for sure. And if you're, you may be in a position where, you've got excellent credit, you've got a lot of equity. Maybe you don't want to touch that first mortgage. Well, we've got HELOCs and HELOANs available. So we can do those as well and try to help get that debt consolidated into a payment that's manageable. And so some of that stuff is really good. We're looking at loans for seniors, reverse mortgages, which have a misnomer that they're a terrible loan, and they really are not a terrible loan. And we're gonna have Michelle here on soon from our office, and we're gonna be talking about reverse mortgages. But even that for seniors, I'm watching seniors that maybe they want to work and that's fine, but having to see them work because they have to work because they can't afford to live just on Social Security and no pensions. These are loans that are out there that are available to help them, and in most cases can help them substantially.
I have one client right now who's talking about doing a reverse mortgage, and what you're describing is exactly what they're in. He's in his 70s, and he's talking about going back to work because he wants to work, which is great, no problem with that. But he has to go back to work because they can't afford their debt load that has come on through some couple of events, and a reverse mortgage would ease their lifestyle significantly.
I spoke to somebody over the weekend, and a friend of mine, and he was telling me, he just retired, and he was telling me, he says, retirement budgets are a whole different animal than when you have a working budget. And I said, it is. And I started talking to him a little bit about reverse mortgages, and he didn't really he didn't know about it at first. And so we're going to be looking and seeing if we can help them do something, because the reality of it is, if I can knock out their mortgage payment, and it's a fantastic thing that you don't have to worry about making that payment anymore. So, but we'll have a whole podcast just dedicated to reverse mortgages to educate it on that. We talked about USDA. I mentioned it a little bit. There's some exciting news about USDA. USDA announced today that effective March 4th of this year, they're going to allow manufactured homes, existing manufactured homes, to be used for USDA financing.
That's going to be huge.
Yeah, they've had a pilot program for quite a few years now on new manufactured homes, and some states were able to do some existing, but now it's going to go nationwide. And so we're really excited about that here in Central Florida, especially since the price of houses have gone up so much. It's maybe a really good way for somebody to get into something that's affordable and still a good home.
No, absolutely. I mean, last year I probably did more manufactured homes than I've ever done. And so with USDA coming on board and the house pricing being just a little bit too high for a lot of people, this is going to be a great alternative for them to get into something that is affordable and a secure, no gimmick loan that's just going to take care of meeting that niche in the market there's a lot of people who are actually probably will be interested in moving forward into that.
I agree.
So that's going to be good. FHA with the increase in loan amount, that's going to be a great thing too.
$524,225, I believe it is.
So between those two, home affordability is coming back on the table. With FHA's, with that high limit, I mean, almost, I don't know what the percentage is, but the great majority of houses can go FHA in Central Florida. So, that's only 3.5% down. So things are starting to work in the buyer's favor.
Yeah.
We get a little bit of help with interest rates, and it's going to be a great year.
It's even helpful even on the conventional stuff because you have buyers that they're more well qualified. Maybe they're on their third or fourth house, they're on their step up home, or they're getting ready for their retirement house, and they want to spend a little more. Well, you can go up to $806,000 now on conventional, and it's not considered a jumbo. The best part about that is that you're not paying jumbo interest rates, right? And jumbo fees. And so there are programs available. The dollar amounts are starting to line up where we need them to be. Rates are going to be rates, guys. You said it before on this podcast, right? You marry the house and you date the rate.
Yep.
That's been the phrase of 2024, if you will. But it's going to carry over to 2025, I believe, for a little while anyway. And it's something that y'all need to be prepared for in regards to what we can do to help you manage a payment that you're comfortable with for a short period of time.
No, I agree. So I think the big thing is sitting down, talking to your loan officer, and creating a plan that works for you and your family. Not just, hey, we want a house. No, what does it make sense? Does it make sense to buy down rate, not buy down rate? Does it ask for seller concessions? What does that look like? What is it going to look like if you're at this price point versus this price point? Start making those plans, even if you're like 8, 9, 10 months, a year out in your thought process. Now's the time to start making those plans, because you have to have an idea of where you're going, because if you don't have a plan, it may not work when you get there. So let's go ahead and get through some hurdles that you may have, whether it be financial or credit, and let's start coming up with a plan for you and your family so you can be successful and get what you want.
Yeah, definitely. And mortgages are just part of that plan, right? They're always part of the financial plan. And you said it so well, because the reality comes in that it has to be part of a plan. You have to look at your overall picture on your finances. Like you said, where do you want to go? Where do you want to be? Is this a first house? Is this a second house? Do you pay points? Do you not pay points? Do you go with down payment assistance? Do you not go with down payment assistance? Depends on your situation. So there is never a loan that's the same. There's no cookie cutter loans. Everybody has a scenario that we try to help them work through and guide them a little bit on what could be the best path for them. Give them some advice and then let them make their choices. That's the most important thing we can do as loan officers.
Well, I agree. I mean, part of the whole thing is educating the borrower on what we're seeing. Once we get them inside of an application and we do a soft pull to see what their credit history, what their income is, debt to income, their overall profile. Hey, this is what we're seeing. This is what you need to work on. This is what this payment looks like. This is what this is going to be. Oh, you can get to where you want to go, but you're going to have to pay down maybe some debt. Or save up some money so you can buy down some interest rate or put a bigger down payment. Whatever that works out to be for that family, we just have, I know for my family, if we know what the information is, we can work towards it. But if we kind of put our head in the sand and, think we're going to be fine, and all of a sudden it's, we're up against a wall, it makes it hard for everybody. There's a lot more stress.
Oh, for sure. And listen, folks, if you are out there getting ready to purchase a house and you think 2025 is your year, please start with getting pre-approved. Please start with that. The realtors will appreciate it. You will appreciate it because it gives you a real sense of what you need to be at. One of the questions I've always asked clients when I first meet with them, especially first-time home buyers, is, hey, have you been looking on Realtor.com or any of these other places? And of course, they all say yes. What price ranges have you been looking in? Oh, $350, $400. That's great. What kind of payment you're looking for? Oh, we're hoping to be about $1,800, and then I give them the reality check, right? And so sometimes it's not a matter of the price point; it's a matter of the payment. And so, what payment do they want to pay, as opposed to, what house do they want to get, because they may not line up. And that's part of what we have to do in the education process, is to say, okay, here's reality. Here's what we can do. We can put you in a payment here that may be comfortable for a little while, or make you maybe uncomfortable for a little while. But if you can hang on to that, because we can still get you qualified for it, we'll get you out of it in a certain period of time, or at least our best of our ability to get you out of it with some kind of a refinance or a streamlined refinance for FHA or whatever kind of loan it is. And so I think that's some of the stuff that we have to do in the education process for these buyers, especially first-time home buyers.
Absolutely. The other part of it is, when you just plug in $300,000 at 7% interest, that's a payment. you have to remember that your insurance and taxes are going to go into this also. So a lot of people are like, okay, we know that they're going into it, but they don't understand that, hey, if it's a 15 or a 20-year-old home that doesn't have a new roof, that insurance payment may be a lot higher than what you're anticipating. So therefore your borrowing power goes down. So part of the process of making up a plan is educating them on, hey, let's look for newer homes because you need this insurance number to be low. So we probably need to be at 10 years or less on roofs, and so that way they can set up the realtor with a search that will actually meet their criteria instead of finding a house that, yes, it on the surface fits the budget, but once the insurance quote comes in, it doesn't. So we got, it's all about the whole package, not just simply the principal and interest.
Yeah, listing agents, if you're watching, make sure that you start looking at those roof ages and maybe start talking to your sellers about, why don't you offer to put a roof on rather than lower your price?
Agreed.
So we've seen it too many times with the insurance companies that some won't even write the policy. It's crazy.
Yeah, no, I mean, I have one right now, missing a few shingles. Roof is actually in pretty decent condition. So 9-year-old roof, cannot get insurance. They had to fix the roof in order to get insurance. So the insurance market is definitely tight, and it plays into the mortgage market. So that's all part of the plan. Thankfully, it's all working out for the client, and hopefully they'll close this week.
Well, it's a good thing. That's a good thing. And, so, like we say, there are programs available. There's all kinds of programs available, folks, depending on what your circumstances are, what kind of house you're purchasing. When I say that, I mean, is it a step-up home? Is it a first house? We will do our best to guide you along the way and get you the information that you need so you can make an informed decision, because the reality of it is this is going to be the biggest investment of your life to this point. And so our job is to try to give you as much education and as much information as we can so that you can make the choice that you need to make in regards to payment or style or loan or whatever it is. And we've got all kinds of loans available for all different kinds of borrowers, whether it be a primary residence, a second home, an investment property, self-employed borrowers. We can cover the gamut. And so that's some of the stuff that Mortgage Financial Group strives at to do excellence.
So the other part of that is as we're educating, obviously the client, the borrower, is talking to friends. They're getting feedback from different people because they're excited about what's going on. Just remember this. There are no two mortgages that are identical. Sure. We can put two twins next to each other. They're not going to have the same process. Just not going to happen. So as you start to get those questions, call us, email us, text us, whatever it is, we will help guide you through. Had a question over the weekend that, hey, my friend just told me that this is what's going to happen, and it was wrong. It was didn't even make sense, but they didn't know. So I was able to explain to them, this is what's really going to happen, and I explained it to them and calmed them down, and everything was good to go.
Yeah.
So it's just a matter of, hey, if you have questions, by all means ask us. We try to answer all the questions up front, but there's going to be always new questions come in. We're here to help.
Mom and Dad can give great advice, but when they bought a house 20 years ago, they just don't know the mortgage market.
Right.
We appreciate you, Mom and Dad. We do. We really do. So it is a game of education, and that's what we're going to make sure we do for the borrowers. So we appreciate everybody trusting us with their loans, with their referral business, and with being able to be in a position to help these individuals in purchasing. So, hey, Rich, I want to thank you so much for being part of the podcast this morning. We appreciate all of you out there. Thank you again for tuning in. Please remember to subscribe and like. And until next time, we'll see you soon.